So let's get right to it. Is this incredible boom in artificial intelligence a real, sustainable revolution? Or is it a massive bubble that's just about to burst? It's the question on every investor's mind, and today we're going to break down the key warning signs you need to know about. Let's start with this classic warning from the legendary investor John Templeton. It's just a powerful reminder to stay skeptical, especially when the excitement in the market reaches a fever pitch like it has with AI. And that's the perfect lead into our first section, because to really understand what's happening in the present, we need to look back at a moment that feels, well, eerily similar, the dot-com bubble of the late 1990s. Okay, so let's set the scene. It's the late 90s, and the internet is the next big thing. Money was just flooding into any company that had a .com in its name. And for a few years, it was an absolutely wild ride up. But then, in 2000, it all came crashing down. The NASDAQ plummeted almost 80%. And get this, less than half of those .com companies even survived. It was a brutal, brutal lesson in market hype. So you fast forward to today, and the buzzword has changed from internet to AI. But that frantic energy, it feels identical. So is this just a repeat of the same old story, or is this time truly different? Let's investigate the warning signs. That leads us right to the first major warning sign. This isn't just hype we're talking about, it's a full-blown arms race, and the scale of spending is almost hard to wrap your head around. The first warning sign is just how concentrated everything is. The magnificent 7 tech giants now make up over a third of the entire S&P 500. Think about that. It means that even if you just own a simple index fund, you are making a massive bet that a tiny handful of companies are going to win this AI arms race. And how much are they betting? A staggering $330 billion. That's the combined amount that just 4 companies, we're talking Microsoft, Amazon, Google, and Meta, are planning to spend on AI in a single year. And to put that number in perspective, that annual spending on AI is more than the entire economic output of countries like Finland or Portugal. This isn't just an investment, it's a tidal wave of cash shaping the future. And frankly, this spending is what seems to be keeping the entire economy afloat right now. Okay. For our second warning sign, we really need to look at how this money is actually moving. It's a crucial and pretty fascinating concept that's being called the AI money machine. So what is it? Well, at its core, it's a system where big tech companies invest billions into AI startups. Those startups then turn right around and use that same money to pay the big tech companies back for essential services, like cloud computing. So what happens? Everyone gets to record it as revenue, and all their stock prices go up. Here's a perfect example of how this works in the real world. Step 1, Microsoft invests in OpenAI. Step 2, OpenAI pays that money right back to Microsoft for cloud services. Step 3, Microsoft uses that revenue to buy essential AI chips from NVIDIA. And then, to complete the circle, NVIDIA invests back into some of those very same AI startups. The money just goes round and round, boosting everyone's revenues along the way. Here's a simple way to think about it. Imagine I pay you $1,000 to dig a hole. Then you pay me $1,000 to fill that same hole back in. On paper, we both just made $1,000 in revenue, even though no real economic value was actually created. It's an oversimplification for sure, but it captures the essence of how these revenues can be artificially inflated. So the crucial point is, who's actually winning in this setup? Well, NVIDIA is the clear winner. They're selling the shovels, the essential chips, to everyone in this gold rush. I mean, their stock is up a staggering 1,600% since ChatGPT launched. Meanwhile, you've got companies like OpenAI who are digging the mine, but they're not striking gold yet. In fact, they're still losing money despite having a massive valuation. Okay, this brings us to our third and final warning sign. And this one isn't about money, but something even more fundamental, a potential physical limit to AI's growth. So AI models improve by devouring data, but look at the bars on this chart. Projections are showing that by 2027, the amount of data AI needs will be nearly equal to all the human-generated content available online. The industry is rapidly approaching what people are calling a data wall. And this poses a critical threat to the entire industry. I mean, today's sky-high valuations are priced for perfection. They assume this incredible progress is just going to continue forever. But if the primary fuel for that progress is about to run out, where does the growth come from? And this highlights a really fundamental difference between us and AI. We don't just learn from static text, we learn from experience, from physical interaction, from trial and error. And until AI can generate its own new high-quality data, maybe through robotics or advanced simulation, this data wall remains a major hurdle.
Okay, so we've looked at 3 pretty big warning signs. It might sound a little scary, I get it, but this doesn't mean you should panic. So let's shift to a practical playbook for how to invest smartly, even in uncertain times like these.
First, let's be really clear. This isn't an exact repeat of the dot-com bubble. Today's AI giants have real products and massive profits. They aren't just hype. So the key isn't to run from the market, but to navigate it with a timeless, disciplined strategy. And the strategy is surprisingly timeless. First, invest consistently. Automate your investments into low-cost index funds and never, ever panic sell. Second, focus on increasing your income. That's the fuel for your investments. And third, the most important rule of all, diversify. And diversification just means not putting all your eggs in one basket. Spreading your money across different types of assets, stocks, bonds, real estate, precious metals, is the key to surviving any market bubble. It protects you from the volatility of any single sector. And that's really the ultimate takeaway. If you understand these dynamics, a market crash doesn't have to feel like a catastrophe. It starts to feel like an opportunity. Because when everyone else is running for the exits, a prepared investor can take advantage, setting themselves up for that inevitable recovery. Thanks for joining this explainer.